So how do you evaluate properties for a return on investment?
It depends. You can evaluate for a couple of different things. For a long-term property or a short-term hold. A short-term hold would be something you buy, you fix up, and then you sell again. A lot of people call it flipping.
Right.
Or a long-term, which is you buy it, you fix it up, if it needs fixing up, and then you rent it. You hold it long-term. So which one?
On the second.
Okay, so buying and holding. Essentially, you're gonna look for three different things. You want to evaluate essentially three different things. Well, four different things, let's say. One is, what's the equity position? Do you have an equity position in the property? If you're buying a $200,000 property that should sell for $200,000, you're buying it at $190,000, you're getting a little bit of an equity position. $10,000 from, because it could sell down the street for $200,000, but you're buying it at $190,000. But by the same token, you could be paying $210,000 for that. You could sometimes go down the street. I've seen where people have bought properties at auctions and they could have gone down the street and bought the same property for $10,000 less.
Right.
You want to know just generally, if it's on the open market and you're buying it, you're probably paying whatever that value is. That is if you're buying it off the MLS. Most people are buying investment properties off the MLS. But to be careful, if you're not buying it off the MLS, you want to check and see what that value is. Check with a real estate agent, get a comparative market analysis to see what that value is. The second thing is you want to evaluate for cash flow. So you're holding it long term. You want to see what kind of rents you're going to get and how long what your time frame of holding it is, if that's going to make sense. Now, because your rents are going to go up and your expenses are going to go up over time, but your rents are probably going to go up more than your expenses are over time. It is, $2,000 in rents, $500 in expenses. Everything goes up, let's say 5% over 2 years. Your $2,000 goes up to more money than your $500. That's what I mean. So it's looking at it not just short term, but over the long term. Is it a good deal now? Are you going to be able to raise rent? Sometimes people buy and they inherit a tenant that's already paying low rent. They know they can raise the rent there. But looking at that rent and seeing where it's at, is it high relative to what the market's offering, or is it low relative to what the market's offering? Usually it's low, especially if the tenant's been there a long time. So sometimes you can raise it, and what is your estimated value of the market in rent? The third thing is you want to evaluate for repairs. So not everybody takes into account the repairs. They'll buy a $200,000 property. You're just looking, they're buying a $200,000 property and there's another one down the street that's $210,000. And they go, oh, well, I'll buy the one that's cheaper. But it's not cheaper if it needs $20,000 in repairs.
Right.
So if you're buying the $210,000 property as opposed to the $200,000 property that needs $20,000 repairs, you're coming out ahead. It's less cash that you have to come out of pocket, which you're not getting. When you buy a property, you can usually get a loan and therefore leverage the amount that you're in. If you have 25% down on a $200,000 property, that's $50,000 down. 210, it's what, 5.25 or 50.25. 52,500 at 25% down. But if it costs you that $200,000, it costs you another $20,000 in repairs, then you're at 70,000, not 50,000. So you're actually coming up with more money. The return on investment, therefore, if you're getting the same amount in cash for rents and your expenses are the same, whether it's a $210,000 or $220,000 property, then one property you have 52.5 in, the other one you have 70 in, you're going to get a better return on investment for that because you've outlaid more for the repairs.
Right.
Fourth thing you need to look at is market, like market timing. What's the market doing? Is it really up? Is it really hot? Is everyone after? Is the market low? In 2009, 2010, nobody was buying. Not a lot of people had money, but the market was really low. It was a great time to buy. In 2005 and 2006 and in 2021, 2022, the market was fairly high. And it came down. It still hasn't come down much from 2022 here in 2025. But where's it likely to go into the future? I think that most markets are going up. So I'm inclined to think that the prices and the values of property are going up over time. I don't know why they would go down more unless there's a really strong hike in interest rates. So, with regard to what the future holds for real estate, I think it's going to continue to go up.
Thank you.